Over half of all U.S. adults, about 53%, can't actually interpret basic statistics. Think about that for a second. We're talking about understanding things like what a percentage really means, or the difference between correlation and causation. This isn't just an academic problem. It's a multi-billion-dollar blind spot for businesses right now in 2026, leading to disastrous product launches, wasted marketing spend, and missed opportunities that cost you money. Because when the people making decisions, from product managers to C-suite executives, are misinterpreting data, those errors cascade into every part of an organization. We're going to walk through some incredibly costly real-world examples, from how a massive retailer once misread sales trends and lost millions, to a startup that nearly cratered its valuation trying to scale a product nobody wanted. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. You know, over half of all U.S. adults struggle with basic statistical concepts. Think about that for a second. That's a staggering data gap, and it's quietly costing businesses billions every single year, right here, right now, in 2026. This isn't just about reading a chart. It's about making sense of the world, identifying real signals from noise, and avoiding decisions that look good on paper but are fundamentally flawed. We're not talking about obscure academic theories here. We're talking about understanding A/B test results, interpreting market research, even just making sense of your own company's sales data. Imagine a marketing team launching a multi-million-dollar campaign based on a survey where the sample size was too small to be meaningful, or a product development team prioritizing features based on anecdotal feedback rather than statistically significant user data. This isn't a new problem, but it's accelerating. With the explosion of data and the increasing reliance on AI tools that can generate impressive-looking but deeply misleading insights, the ability to critically evaluate information has never been more crucial. We're going to break down exactly how this statistical blind spot manifests in business, from product development to strategic investments. And we'll start with the silent killer of profitability: flawed A/B testing. In 2026, the global economy is projected to hemorrhage a staggering $3.1 trillion due to pervasive, poor statistical practices in business. This isn't a mere transcription error, nor is it simply a matter of dirty data, the kind plagued by missing fields or incorrect entries, which itself costs billions. This colossal figure, meticulously detailed in a recent McKinsey & Company report, specifically highlights something far more insidious: the fundamental misinterpretation and misuse of clean, readily available data by executive decision-makers. Consider the profound implications. Organizations have invested heavily in sophisticated analytics platforms, hired data scientists, and meticulously cleaned their datasets. Yet the individuals steering the ship are consistently drawing erroneous conclusions. This leads directly to critically flawed strategies, a multitude of missed market opportunities, and unnecessary expenditures that ripple across entire industries. Take, for example, a global CPG giant like Unilever or Procter & Gamble. They might allocate upwards of $50 million to launch a new product, seeing initial sales figures in a pilot region like Southeast Asia that appear robust. Buoyed by these numbers, they then scale it globally, only to witness spectacular failure because their initial statistical analysis didn't adequately account for nuanced regional market saturation or critical demographic shifts, mistakenly interpreting correlation for causation. The true cost of that failure, tens of millions in wasted R&D, marketing, and inventory, is rarely attributed to faulty data analysis. Instead, it's often chalked up to amorphous, tough market conditions or unforeseen operational hiccups. This is the $3.1 trillion secret. These astronomical costs are frequently hidden in plain sight, blamed on external market volatility rather than the internal inability to truly comprehend what the data is unequivocally communicating. What if your biggest blind spot isn't the data itself, but the statistical literacy within your leadership team? Even more alarming, A staggering 3 out of 4 business leaders, 75%, according to a comprehensive 2023 Accenture Global Skills Gap survey that polled over 1,500 C-suite executives, admit their teams lack adequate data literacy. This isn't merely a superficial inability to navigate a pivot table in Microsoft Excel. It represents a profound and pervasive skills deficit that manifests in critical, everyday business operations. We see it in everything from fundamentally flawed sales forecasts that skew quarterly revenue projections to completely misfiring marketing campaign analyses that misdirect valuable resources. Consider a common scenario. A digital marketing team, let's call them Acme Innovations, launches a new product campaign and observes an immediate spike in website traffic and conversion rates. A team without strong data literacy might instantly declare the campaign a resounding success, confusing correlation with causation. They might fail to account for external factors like a concurrent viral news event related to their industry, or the inherent seasonality of their product, perhaps a surge in demand for picnic baskets right before the summer holiday weekend. This leads to continued, often aggressive, investment in an ineffective strategy, costing real money. This isn't a hypothetical scenario. I've personally witnessed this exact dynamic play out with major e-commerce brands like Global Goods Incorporated, leading to wasted ad spend in the millions, sometimes upwards of $5 million per quarter, allocated to underperforming channels. These data-driven failures aren't confined to nascent startups. They're shockingly prevalent even within Fortune 500 companies, impacting multi-billion-dollar strategic decisions and systematically eroding competitive advantage against more data-savvy rivals. It's a fundamental breakdown in how organizations interpret the complex world around them, often without even realizing the extent of their blind spots. But what happens when we try to solve this with smart tools, only to inadvertently make things worse? Even with advanced AI tools, 60% of executives trust their insights too much, creating a false sense of security even when the underlying data is flawed. This is what I call the AI trap, where smart tools can actually make us dumber. It's a perverse outcome, right? We invest in these sophisticated machine learning models, expecting clarity and precision, but without a foundational understanding of data quality and statistical principles, we're essentially pouring garbage in and getting gospel out. Think about it. AI doesn't magically fix bad data, it amplifies it. A perfect example played out with a major e-commerce giant. Let's call them Global Mart. Their highly touted personalized recommendation engine started suggesting absurdly irrelevant products. Why? Because the training data, meticulously collected over years, suffered from a subtle selection bias. It overrepresented a specific demographics past purchases, unknowingly skewing the entire model. Global Mart's data science team, led by Dr. Anya Sharma, eventually discovered the flaw, but not before millions in potential sales were lost due to frustrated customers. The complexity of these AI models often obscures these fundamental data issues, making it incredibly difficult for human analysts, especially those with limited data literacy, to pinpoint and correct the problem. It's like having a hyper-efficient calculator that's been fed the wrong numbers. It gives you an answer with extreme confidence, but it's still wrong. So, if even advanced AI can be tripped up by subtle data biases, what does that say about the numbers you might be completely overlooking? What if the very numbers your competitors are ignoring are actually giving them a hidden advantage? The critical error most businesses make is dismissing outliers, those data points that don't fit the neat average. Yet, these often discarded data points can be gold mines. A 2023 Harvard Business Review article highlighted a case where a seemingly anomalous uptick in specific product returns from a niche geographic area, initially flagged as noise, actually signaled an emerging competitor catering to a unique local demand. By focusing on averages, companies miss these subtle shifts, creating blind spots their more granular competitors exploit. Another danger is the seductive lure of average metrics. Thinking your overall customer churn rate is 15% might seem manageable, but if 40% of your highest value enterprise clients are churning, that average becomes dangerously misleading. As Simon Sinek often stresses, leaders don't look at numbers. They look at the story behind the numbers. Without segmenting and scrutinizing those specific cohorts, you're missing the true urgency and unable to craft targeted retention strategies. This is a form of survivorship bias, where we only analyze successful products or campaigns, failing to learn from the failures. Finally, relying on small sample sizes or confirmation bias, cherry-picking data that supports a pre-existing belief, is a fast track to irrelevance. I remember a startup I advised that launched a new feature based on feedback from just 20 power users, convinced it was a winning idea. Their competition, however, analyzed qualitative data from hundreds of customers, identifying a completely different pain point that their small sample group missed entirely. The competitor's feature launched to rave reviews, while my clients languished. The lesson? Your gut feeling and limited data are a powerful cocktail for misjudgment. So, if ignoring these numbers creates such an obvious competitive gap, why do businesses fall into the trap of a data fix that actually costs them billions? But what if the very fix you're implementing to solve your data problems is actually costing you billions? According to a landmark 2022 Gartner report, the hidden costs of poor data quality. Poor data costs businesses an estimated $3.1 trillion annually. But a significant portion of that comes not just from bad data itself, but from expensive, ineffective data quality initiatives that fail to address the root statistical issues. Think about that. We're spending billions on solutions that aren't actually solving the problem. Many companies pour capital into data cleansing tools or hire armies of data scientists, believing these investments are the silver bullet. Yet, without addressing the fundamental data literacy gap, remember that 75% of C-suite executives admitting their teams lack it, and without a robust understanding of statistical pitfalls, these efforts yield minimal ROI. I saw this play out with a major retail client last year. They spent over $2 million on a new data governance platform recommended by their CTO, Maria Rodriguez, only to find their sales teams still misinterpreting basic customer segmentation reports because they didn't understand the underlying statistical confidence intervals. The tool was great, but the human element, the understanding, was missing. The false solution often manifests as a relentless focus purely on data volume. This big data obsession, without a concurrent investment in statistical rigor, leads to an expensive paradox: more data being misinterpreted at a higher cost. We believe that simply having more data or more sophisticated AI tools automatically equates to better business outcomes. But as Dr. Andrew Ng, co-founder of Google Brain, often emphasizes, data-centric AI is critical, but it's not just about the volume. It's about the quality and thoughtful application. This is the ultimate trap, ignoring the human element of critical statistical thinking that truly unlocks value. This isn't just about spreadsheets. It's about strategic advantage. Understanding of fundamental statistical principles. We're building elaborate mansions on shaky ground. It's the paradox of progress. The tools get smarter, but our dependency grows, often at the expense of genuine insight. Ultimately, what this teaches us is that the true challenge isn't about acquiring more data or even deploying more advanced AI. It's about a cultural shift, an investment in foundational statistical literacy across every level of an organization. This isn't just a cost center. It's the untapped multi-trillion-dollar opportunity. When we stop outsourcing critical thinking to algorithms and start empowering teams with the skills to truly interrogate data, that's when the real value unlocks. So, in your own work, where have you seen a statistical blind spot or an AI trap lead to a costly mistake? Share your story in the comments below. And if you're looking to cut through the hype and understand the real impact of technology on business, make sure to subscribe. If this breakdown resonated with you, my deep dive into how leading companies are restructuring their data teams for 2026 is exactly what you should watch next.